Assalamualaikum and hello everyone. Welcome back. This is the second video on the preparation of consolidated statement of financial position for the company called Lily and Rose. That is the group of company here, right? And this is using question September 2011, the edited version. We have already done the preparation of the template, and we have gone through the identification of and the consolidation that need to be done, as well as looking at the intercompany transaction here, and we have identified which particular information relates to which particular consolidation issues. So if you look at the requirement here, you are required to prepare the consolidated statement of financial position. When you ask prepare the statement of consolidated financial position here, right, you are not just going to prepare the blank format which just combine the group and the subsidiary. What you need to also do is you need to prepare this schedule which compute the group reserve and non-controlling interest. Okay, if you look at the schedule that I prepare here, you would notice that the schedule here consists of few columns, right? It consists of few columns where the first column is on the item, the second column, third, fourth, and there are altogether 5 columns, if you can see in terms of the column which relates to reserve. The first one is I create a column for retained profit of the subsidiary. This second column is for the group retained profit. The third column is for the general reserve. So this reserve that you create here will depend on what reserve are you given here. So if you are given retained profit, so there will be retained profits column. If you are given general reserve, there will be general reserve column. Okay, that is what you need to do. And on the same in the same column, you also going to create one column for your non-controlling interest, because you need to find this total here, these 3 total here that I put different colors, that you will later transfer to your consolidated statement of financial position. Remember earlier I've shown you this one, and this color here, right? So this one will be transferred here, so it comes from the schedule. So there are 3 things that are from the schedule, including also to calculate the goodwill. Okay, before we go further to do our consolidation adjustment, if you look, apart from preparing the schedule, which is going to be done in a short while, and after you have already prepared the blank format and you have done the combination of the parents group and the which is the parent and the subsidiaries asset and liabilities and equity, you also need to calculate the goodwill, because the goodwill will later be included in the non-current assets section after taken into consideration any impairment loss. So you can start doing that now, right? But before you calculate goodwill, there are 2 things that I would like to highlight. Before you calculate goodwill, go and check if the additional information or the adjustment that you have here, does it include any fair value adjustment? So in our case, if you can still recall, right, let me just open up this for a while because I need the pen. I'm going to use a different color. I'm going to use purple, right? This is purple. Okay, again, close it back. Right, so you would notice that the first item here, that was fair value adjustment, and that happened on the date of acquisition. So whatever that you will affect the fair value of net asset on the date of acquisition, remember our date of acquisition is on 1st of July, year 9. So we need to go and do that adjustment first. So if you can see here, you have your fair value adjustment here. So we're going to do that first. On top of that, because that would affect the reserve here. So there will be some asset revaluation reserve on the date of acquisition because previously it was not recognized. So we need to do the adjustment first. Second one is if there is a bonus issue. So in your case, if you go to information number 6, right, number 6, that is on bonus issue number 6. So you need to go and settle that first, because if there are bonus issued by subsidiary, of course the ordinary shares of the subsidiary will rise, right? So you need to go and take into consideration that bonus issue. As I've reminded earlier, you need to go and also decide which reserve is being used. We have already decided the post-acquisition reserve will be utilized because there is no pre-acquisition reserve balance. So we'll be doing that first. So I'm going to do number 2 and number 6. Before that, I will be doing the calculation of goodwill. So I will just find out what is the calculation or the amount for my consideration that I have transferred to acquire the ordinary shares. So if you look information given here, the investment total for the acquisition in the subsidiary company was 700,000, but the breakdown of it is given at the bottom here. So you would see for the ordinary shares, right, you will have the amount to be transferred. So let me just open up that for you. The amount to be transferred would be the amount would be 585,000. It should be somewhere here. Just move it a little bit. So 585,000. All right. So that is from our information here. Then you have to find out the fair value of net asset. For the retained profit, if you were to include the reserve balances, you would see that it has a negative balance. So just put it in bracket, right? Or you just leave that negative sign there. Okay, and then you need to find out what are the pre-acquisition revaluation reserve due to the equipment. As I said, also doing the bonus issue. So let's do that first before we can calculate the goodwill. I've done that here for your easy reference. So this is number 1, which relates to the fair value adjustment information 1. This is information 2. So take note, I've already drawn the diagram earlier here, the timeline diagram. So put the fair value on the date of acquisition, 720,000. You need to find out the carrying value also on the date of acquisition, because your target is to find the surplus. So to get that, you will take the carrying value here, and you need to gross up to 2 years earlier. So to gross up, this use reducing balance method. So you have 10%, and that was on the carrying value. Okay, so what you will do is you will multiply with 100 over 90. 90 is because 100 minus 10, 90. So for 1 year. So this is when you are trying to find for 1st of July year 10, but you're not trying to find on that date, trying to find on the day of acquisition. So you will do that 100 over 90 twice, and you will get 654,321, and that gives you the surplus of 65,679, which is surplus on the date of acquisition. So after you have done that, you can do the journal entry for that. right? Where the journal entry for that is to debit the property rows and to credit the asset revaluation reserve and adjust the pre-acquisition balance on the date of acquisition. So 65679 here will appear in your working section in your calculation of goodwill. So let me just doing that. Okay, so it will appear here. So it will appear here 65679, and at the same time this figure of 65679 that you debit to the property will have to be added to your PPE, or that is part of the consolidation adjustment, right? That will be done later. We're going to do that in our consolidated statement of financial position, because when you debit, it means you need to go and add to the adjustment. So that is for the first thing. Second one is the depreciation adjustment that you need to do from the date of acquisition, 1st of July year 9. You need to do it for 2 years because the current financial year end is 30th of June year 11 for 2 years. So that is to be adjusted in the retained profit of the subsidiaries, because subsidiaries has not done the depreciation according to the fair value. The fair value must be reflected in the group consolidation. So the adjustment for depreciation also should have been based at the fair value. So the shortcut way of doing is taking the surplus. You can do this if this is reducing balance method, times 10% if you were to do it, or to find the adjustment for year 10, which is trying to do the adjustment from the date of acquisition until the current year end, right? Okay, so here you're doing it here and you get this figure. Okay, there now, right? So you get 6568, and the second one is for you to do the second adjustment, which is to find out the depreciation adjustment for the second year. So it would be based on the carrying value, because we are talking about depreciation, which is reducing balance method. So you take the 65679, the surplus, minus the depreciation adjustment here. So 6568 times 10%, you have 5911, and the depreciation that has been underprovided is 12479. So when depreciation has been overprovided by the subsidiary, there is no buyer or seller here. Subsidiary's asset is being underprovided in terms of its depreciation, because subsidiary is still depreciating based on the carrying value, whereas now the asset is reflected to its fair value of 720,000. So therefore the depreciation, you total up this 12479 to retain profit will be debited. 12479 retain profit of rows, remember to adjust that in the schedule. Adjust that in the schedule. And credit plan and equipment, that will be adjusted directly, because plant and equipment is at carrying value. Unless you are given the accumulated depreciation, you can go and adjust to the credit side of the accumulated depreciation for plant and machinery. So there's 12479. So because you credit plant and equipment later in the preparation of statement of financial position, remember the elimination or the consolidation adjustment part, you need to go and deduct. Right, done with that. Information number 2. Now we go on to information on bonus issue. For your information, bonus issue, if there are bonus issue, we need to check whether it is out of pre or of post. Since there is no balance in the pre-acquisition reserve, we conclude that bonus issue will be out of post-acquisition reserve. To recognize the bonus issue out of post-acquisition reserve, you just need to debit the reserve being utilized, and it is the post-acquisition reserve balance. If you check earlier, the balance was 50,000. here it is post-acquisition reserve balance was 50,000 before adjustment. You can make use of that to issue bonus share. All right. So it's more than enough. So how do you get 40,000? 1 over 20 times RM 800,000 amount of ordinary shares in subsidiaries. So we have 40. So debit general reserve of rows out of post-acquisition general reserve and credit ordinary shares of rows. So when you credit ordinary shares of rows, this will affect the ordinary shares balance of rows to be increased by 40,000. So this will be adjusted in the fair value of net asset. I put here FINA, FVNA, and also will be adjusted in the schedule relating to the calculation of the group reserve, general reserve of rows. So let's look at the working section that affect that. That is the first entry. The second entry for you to pass, because this is the case where bonus issue is out of made out of post acquisition reserve, right? The effect is that bonus issue will be increased and will be increasing the ordinary share of the subsidiary. So the ordinary shares of the subsidiary that will be included in the calculation of fair value of net asset will be the one after considering the bonus issue. As I mentioned, pre-acquisition reserve, should there be any, will be utilized first. And if it's not there, the balance that cannot be utilized, because no balance, right, we will be utilized out of the reserve accruing after the date of acquisition, which is from the post-acquisition reserve. So this is what we have already done earlier, the first journal. And now the second journal that you need to pass is to actually capitalize the reserve that is being utilized for the bonus issue, because bonus issue will not affect the goodwill calculation. In order for us to maintain the goodwill, the holding shares of bonus issue out of post-acquisition reserve must be frozen, and therefore an adjusting entry has to be made as follows. So you're going to debit the goodwill and you are going to credit a special account called capital reserve, which is being created for this bonus issue only out of post-acquisition reserve. So what you will do is, I've done it here, debit the goodwill. How much? You're going to credit the capital reserve by how much? 40,000 is this bonus issue. 60% is the controlling interest in the subsidiary. So 40,000 times 60%, 24,000. This one will be the thing that you need to disclose in the capital reserve section in your consolidated statement of financial position. But the one that you debit to the goodwill will need you to go and adjust to your goodwill calculation. You need to go and add that. So let's do that. Okay, we're doing information number 6, which is on bonus issue. So this is on bonus issue. I put here info 6. This is also info 6, right? And this is also related to info 6. So what you need to do is your bonus issue will affect your share capital. So therefore, the share capital that you will include here is after considering the bonus issue. And doing the debit to the goodwill means to add to the goodwill that 24,000. And with that, you can now get your fair value of net asset. That is the total of this 885679. You can now calculate your non-controlling interest, which is 354272, by taking the fair value of net asset multiplied with the non-controlling interest percentage. And your goodwill for ordinary shares now would be 77,593. And you also need to calculate goodwill if there is any for the acquisition of redeemable preference shares, as well as acquisition of debenture. So if you look here, for the acquisition of redeemable preference shares, the cost of investment is 875. I took it from here, right? And the carrying value of the preference shares acquired, which you have acquired 25,000, right? So the difference there will not give rise to non-controlling interest because this is redeemable preference shares that will give rise to a goodwill, which rarely happen, but here it happens, right? Now, the second one is for you to calculate the goodwill for the debenture, if there is any, right? So if you look, the debenture, the cost of investment is 40,000. And the carrying value of the debenture acquired was also the same amount here, 40,000. You do not acquire all. Unless you acquire all, you will take exactly all 100,000 here. None. So therefore, the goodwill is nil, no goodwill, right? Because if you take here, if you just do the calculation, you will see that there are no goodwill. So I put here 0. And the total goodwill on consolidation would be 127,593. 127,593. And that is the goodwill before any impairment took place, the total goodwill. So you are done with that. And if you check, there are no impairment for the goodwill on consolidation. So this figure is the one that you need to go and include under non-current asset as goodwill. And that figure, because it was not impaired, is the one that will be reflected straight away here. Yeah, 127,593. Okay, then now we're going to do the remaining consolidation adjustment. So let's do each of them. I'm now going to focus on information by information. So we have already done number 1 check, number 2 check, done. Now we are going to do number 6 also check. We're going to do 3, 4, 5, 7, 8, and 9. 3, 4, 5, 6, 7, 8, and 9. So number 3 here is on the proposal for the cumulative preference shares by Lily as well as by Rose. So as I mentioned, you need to look at which situation. And here is the situation where both holding and subsidiary has not recorded. And this is the case where when they have not recorded, this is situation 2. Parent has not recorded its own dividend and expense. How do you know? Because you are informed here. And there are also no dividend item under the section of the liability that relates to the parent. Right. So go and record that dividend. So to record, debit retained profit, because dividend are declared out of profits, right? How much? 20,000. How do you get 20,000? 10% from 200,000. 200,000 is the 200,000 cumulative preference shares in the parent. This is the rate, 10%. So for 1 year, 20,000. If you do that, right, you will see the effect here that it would have to be adjusted in the schedule. You'll be doing that. Go and deduct later. And the preference dividend payable here is the one that will be reported in the current liability in your consolidated statement of financial position, this item here. So this one will be reported here in your consolidated statement of financial position. We'll be doing it later. The second one is the dividend being proposed by Rose, right? Dividend being proposed by Rose. If you look at dividend proposed by Rose, where subsidiary and parent have not recorded. Rose is the subsidiary company. So when Rose declare dividend on the redeemable preference shares, because Rose does not have any preference shares which are cumulative preference shares. Rose just have the 10% redeemable preference shares. Don't get confused with the percentage or the rate here, because this reflects the different types of shares. So 100,000. So Rose will have to record. How do you know? Because there is information telling you. So since there is no item of preference dividend, and you can read the tips that I put here. So we are going to record the dividend by rows here. Let me just open it up. Okay, debit retained profit 10% from 100,000. 100,000 here is the 100,000 of the redeemable preference share, so you have 10,000. It will be adjusted in the retained profit of rows, which is in the schedule. Credit redeemable preference shares, this will be adjusted in the current liability section later with 10,000. And remember, when rows declare dividend 10,000, since the parent company acquire 25% of the shares, 25% here, here is the percentage being acquired, right? So therefore, you have the share of 2,500. So the dividend that were declared by the subsidiary was an expense to the subsidiary, but there is an income to the parent. So how to record that? You can debit the redeemable preference dividend of the subsidiary to reduce the payment, then give that to the parent. Credit retained profit of the parent. This is the shortcut method where you record that as an income from subsidiary, but this will not be reported in the consolidated statement of financial position. 25% from 10,000 to 2,005. So this will be shown in the current liability that will be used to reduce this dividend, right? So what will be reported is not 10, it's not 2,500. In the consolidated statement of financial position, you will not report this figure, but you will report 7,500 only for the redeemable preference dividend that relates to the non-controlling interest. Number 4 is elimination of intra-group balance. This one, okay, this is a journal entry where I mentioned the goods in transit. So go and debit the accounts payable 13,500, the one under rows. Go and check it, right? The one under rows, and go and credit the figure 20,500. So you have already explained you on this matter, 20,000 and 6,005. This gives you 13,500. So you need to record the goods in transit. You have two alternatives: either record the goods in transit in inventory or just put a separate row for the goods in transit. Both ways are acceptable. So this will be adjusted later. Everything here does not affect your schedule. It is just affecting your consolidated statement of financial position. Next one is the information on the elimination of the intercompany loan. Remember, this one we have done. This is also done. And we're doing number 5. We need to go and cancel off the intercompany loan with the goods in transit for the case of accounts receivable. For the case of loan, it is due to the cash in transit. So the cash in transit was 20,000, so that will be recorded. Either you can record that directly to the cash account, or you can see what I do here is that I put in the cash in transit 20,000. So this 20,000 is what will be able to eliminate the intra-group balance. So if you look intra-group balance, as I have highlighted in blue here, 70 and 50, this must not be reported because they are intercompany transaction. Earlier I've highlighted that it should have been eliminated, and we have done the elimination already. So this also does not affect your schedule. It just affect your consolidated statement of financial position. This has been done, information number 6. Now we move on to information number 7. Information number 7 is regarding debenture interest of rows that has not yet been credited by Lily. So this is situation number 3, where subsidiary has recorded the interest or dividend payable. Here is interest, but the parent has not taken credit of its shares. So parent only has the right to take the income or credit the income if parent acquires the debenture. Here parent acquires, right, by 40% based on our calculation earlier, 40% here. So if parent acquired the debenture of 40%, parent also has the right to the share of debenture interest of the subsidiary. So subsidiary has already recorded this here, and that has been done earlier before the additional information or before we do the adjusting entry here. So that has already been debited in the retained profit of the subsidiary. We do not need to debit anymore. What we need to do is to take the share of the parent by debiting the debenture interest payable. Take some of this that belongs to the parent, which is 40%. 40% from 8,000 is 3,002. So you get this debenture interest that will reduce this debenture interest payable down to it is going to be 4,800. That will be reported later in the consolidated statement of financial position, and this will have to be recorded in the schedule of the reserve retained profit of parent or the group. You need to record that as revenue in parent. But when you report in the consolidated statement of financial position, that must be eliminated. Information number 8, we're almost done, is the inventories. You need to go and do two adjustments here, as I mentioned earlier. One is for the unrealized profit. Another one is to eliminate the amount owing to and from subsidiary. So the unsold inventories was half. If you read the question, you are informed half of the Rose Berhad inventory. So if you go to Rose's inventory 84, half of this 84,000 is relating to Lily. So that must be eliminated. Not that amount, but the unrealized profit related to the amount. So half of 84 from this 84 here is 42,000. That is the amount owing. Since you are informed here, the amount is still owing, right? Amount is still owing here, the blue section here. Then the unrealized profit would be based on markup. So markup, you take 42,000 unrealized profit on unsold inventories times 25 over 125, you have 8,004. The unrealized profit must be adjusted in the seller. So seller here is Lily. Seller is Lily, so it must be adjusted in Lily. Right? Adjusted in Lily. So Lily's Berhad retained profit is the one that would be affected. Right. So debit retained profit of Lily, the seller, yeah, and credit inventories to remove the unrealized profit. It will affect the schedule. It will also affect the current asset section inventories. You need to remove in the retained profit. You also need to remove the unrealized profit because you eliminate. Part B is to eliminate the amount owing to Lily, which is the intercompany amount owing. So you need to go and remove from the accounts payable half of 84,000, just now 42,000. That will not affect the schedule. It will affect only the consolidated statement of financial position. The current liabilities and the current asset must be eliminated by the amount owing of 42. The last item is on information 9, which is bills payable of Rose was drawn in favor of Lily. So when you come across the elimination of this, the bills payable, it must be the undiscounted bills that you eliminate. And the undiscounted bills here, the bills was 12,000, the discounted portion was 4,000. So the difference is 8,000, and that must be eliminated by debiting the bills payable of Rose 8,000 and crediting the bills payable of Lily. Rose bills payable is the current liability. Lily's bill receivable is the one appearing in the current asset. So but do not go and eliminate everything, just eliminate the one that was undiscounted relating to the group member. So that will not affect again the consolidated the group reserve. It just affect the consolidated statement of financial position. We'll continue with the third part in our next video. I'll see you when I will see you. Catch me later in my next video. Assalamualaikum warahmatullahi.